Good morning, ARMR Insiders, and welcome to the morning meeting of our virtual hedge fund. Thank you for joining me. You are going to think of yourself as a portfolio manager on a hedge fund desk. This is our morning meeting. We're going to talk about our portfolio structure, our strategy, how we're going to execute today. You have to figure out your risk tolerance, your goals, what you're trying to do with the portfolio, and then execute accordingly. That's up to you. Okay, you got to be the smart money. How do I use all this information to manage capital for the various portfolios I'm running? And then my goal there is to hopefully share with you our process, then you figure out how it works for you. I have a philosophical discussion I want to have, but I think what we'll do first is we're going to get into the risk monitor and we're going to talk about how our portfolio is structured. Okay, so this is the S&P, and why don't we start with our most aggressive strategy? Trades the most, SPXL. This is our swing strategy for triple the S&P. Now, you and I have been building this track record together since 2022. We have 19 trades, and on Friday, trade number 19 took a loss. The last time that strategy took a loss was trade number 3. In 2023. It was March of 2023, the last time this strategy took a loss. Now let's go over to the risk monitor. The risk monitor went from green to red in a week. And I've shared with you many times as we've worked together that the risk monitor is not a crystal ball. It's not a guarantee the market goes up. It's a high probability strategy, but it's a probability. And there will be times when the risk monitor goes from green to red. And it does it in the first 5 days. That's the most dangerous time of a new risk monitor green signal. Let me get to the philosophical point for a minute. This is very important to me. I've been speaking with a lot of ARMR Insiders, a lot of ARMR Report subscribers over the last couple of months. And I'd say there's two things. There's two issues that you all struggle with the most. And you're not alone. Most investors struggle with this. I struggle with this. I struggled with this. That's why I built the ARMR Investing way. But the first that I'm going to share with you is position sizing. When I speak with some of you, I'm shocked sometimes at the position size you're taking on small cap stocks, micro cap stocks. If you want to take a big position size in Apple, I get it. You want to take a big position in AT&T and Verizon, go for it. But I'm hearing way too many of you, and this is why I'm calling and chatting with all of you. I want to hear what the issues are. What's holding you back when it comes to success? And I'm going to tell you right now, it's position sizing. That's one major issue. You're taking positions that are like massive risk on ridiculously volatile stocks. So you've got to adjust your position size to the beta of the asset. Please consider your position sizing. But this is the real issue I wanted to share with you today. This is the real takeaway that, I don't know, I feel like it disturbs me the most. Because you're holding stocks when the stops are hit. Why? I don't get it. You cannot cherry pick the ARMR Investing way. You cannot add risk when the algos go risk on and then refuse to take money off, refuse to take risk off when the stops are hit. An entry strategy only works as well as the stops that it's married to. There's no crystal ball here. Those entry strategies are probability strategies, guys. It's not a guarantee the market's going up. It's a probability. There's a bell curve. We're in the fat part of the curve. There's going to be tail risk. The stops are there to protect you from that. And what can happen to all of us is we get carried away in the story of the moment. I don't care what the story is. We'll get carried away. We'll fall in love with the idea. You might fall in love with the ARMR swing strategy for the S&P. God, it's making money all the time. Yeah, it is 90% clip. It's making money at 90%, even with the last loss. We're 90% accurate, okay? But you still have to stop your loss when the stop gets hit. And when it comes to executing the ARMR investing way, yes, the algos are great. Puts us on the right side of probability when reward's worth risk. But if you don't marry it to the stop, you're going to end up in the same place you always end up as an investor. Because one of these entry points is going to hit the stop and the market's going to crater. And if you decide to debate that with your, well, maybe not now, maybe I'll wait another day. I love this stock. I think this is a great concept. You're lost. You're just doing the same thing you always did with maybe better entry points, but you're still going to end up in the same place holding the bag. Stops have to be respected. Now let's get on to what is the information that these stops are providing, because it's very important and it'll help you understand my portfolio position. I'm going to share with you now something I've done with my portfolio I almost never do. I don't fear the risk monitor going from red to green in a week. I love that information. The information I love. It's rare that the risk monitor goes from green to red in a week. It's even more rare that the swing strategy for the S&P that we trade together, SPXL, takes a loss. It hasn't taken a loss since March of 2023. So that information tells me the market's a lot more dangerous than people think. And so I am short the indexes right now for the ARMR Macro Fund. Now, before I go any further, I'm sharing this with you not to tell you to short sell, okay? I don't think anybody should short sell. There, I said it. I don't think short selling is for any individual investor. Unless you're sitting on the desk with me trading all day and consider yourself kind of a professional at this, you shouldn't be short selling. Our flagship fund, 50% treasury bills, 20% treasury bonds, 20% stocks that go up when interest rates come down. Interest rate sensitive dividend payers, utilities, defensive stocks like pharmaceuticals, tobacco, energy pipelines. These are the stocks that are in our portfolio right now, and they're going up. That portfolio will work well. It will answer if the market craters in here. You'll protect your capital. Probably treasury bonds go up. If the selling gets ugly enough, they're going to get to almost every group. Sometimes utilities can buck that trend because people are hiding in treasury bonds and utilities, but they'll probably get to pharmaceuticals. I mean, they're in the big indexes. Sometimes they drag them down. You know, in the crash of 2008, they got to the pipelines. So don't think that the pipelines are going to save you if the market implodes. This is not a prediction the market's going to implode. I want to make sure everyone's aware of what happens in a real bear market. We're not in a real bear market. Market's just had a couple down days. But I just want you to be aware what's in your portfolio and what should protect and what may not protect, okay? I mean, pipelines dropped 50% in 2008. So, I mean, you know, if things get ugly, everything goes down. So let's just be clear on that. Treasury bonds should go up if things get really ugly. Right behind that would be utilities. Everything else, I don't know. When I get information from the market, from our algos that we're possibly entering the tail part of our bell curve of risk, I'm willing to put a short out. Look at the rogues gallery. I shared this with you yesterday, and I'm just going over it again. Look at the double top in the Dow. Look at the total breakdown in small caps and mid caps. They look almost the same. Look at the massive correction in leading growth stocks. That's just a huge collapse. And then we can look at some other things from a William O'Neill point of view. This is the IBD 50. Let's talk about the IBD. Distribution days are stacking up. 2 days in a row where the market closes on the lows. These are things that don't happen in a bull market. And it's the canary in the coal mine. We've got to call that like we see it, which is Bitcoin. This was a little bit confusing to me. I said to you guys when the risk monitor went green, I don't get it. Bitcoin is not going up. Bitcoin's not going green. But the piece of information there was Bitcoin was lagging. And Bitcoin's the canary in the coal mine. Don't forget, we used that information and we used the structure of the market as a guide to carrying cash. So when the risk monitor went green, I said to you guys, this particular green signal, my max invested position will still carry around 25% treasury bills. I think a cash position, a treasury bill position is important in this cycle. And I said to you guys, if you remember, down here, when the risk monitor goes green after a 4 or 5 month decline and a double bottom at the 200-day, I can go max long, no cash. Up here, where the market's trying to break to new highs, I'm going to carry a treasury bill position even when I'm max long. All of this comes together. And the Bitcoin, of course, Bitcoin's breaking down today. It's down 5% right now, trading under somewhere around 88,000, 89,000. So Bitcoin's breaking down now fairly aggressively. All of these pieces come together. And so what I've done is I've put on a short position in the Dow on strength yesterday morning. I put that short on Friday. I got short small caps, NASDAQ 100. And here is the highlighted stock of the day. On semiconductors short on Friday. Short semiconductors Friday. This is the uptrend that's been broken. Now, I've been hunting, this is the highlighted stock of the day. I've been hunting the short sale on semiconductors for weeks now. I'm on it again. Put the short on Friday. This week, NVDA announces earnings. I'm going to hold the short through earnings. I don't know. NVIDIA is either going to be the nail in the coffin of this chart, or it's going to offer a reprieve and the semi stocks will go back up. There are a number of reasons why I believe that NVIDIA is in big trouble. I could be wrong. I could be right, but I could be a quarter or two early. So I don't know. It's always a crapshoot when it comes to earnings announcements and how the market responds to it. Okay. But I think that this is an entry point where I'm willing to take some risk into NVIDIA's earnings. We've been talking for months now about the stage 4 base that NVIDIA is building, and it's looking worse and worse. It's attempting to break out of the stage 4 base, and it can't. That chart pattern is prime for a gap down on earnings. I don't know if that's going to happen. I have no information there. Stock could be up on the news and be down by the end of the day. I don't know. But there are this asset is priced to perfection, and there are a number of cracks in the dam. Short semiconductors into that announcement. ARMR Insiders, ARMR Report subscribers, you're on your own. Feel free to throw a question into the comment section. DM me, give me a call. I'm happy to chat with you and help you out. The number is 561-575-6832. Everyone have a wonderful trading session, and remember to be the smart money.